Hey everyone, welcome back. Happy Tuesday and Happy New Year. This is amazing. We're going into 2023. We've got a pretty soft day here on the market actually. The volatility has increased slightly, which is kind of nice, but we're moving into a totally different trading year or type of trading year than we've had for the last couple of years. I mean, interest rates obviously are a thing right now, so it's something that we have to be considering when we're looking at long-term option trades or even holding stock, because any cash that we have tied up theoretically could be used to gain money just from interest, because the interest rates have risen a little bit. If somebody could be so kind as to let me know if everything is working, audio all sounds great. I mean, it looks good on my end, but I always like a good double check. And appreciate you guys joining me here on this first trading day of the year. As always, this is not financial advice. Where's my disclaimer button? Excuse me. Not financial advice, it's just my opinion, but I am willing to talk about anything that you guys would like to talk about. So if you're keen and you want to pull up a stock ticker, please do. We'll take a look. I'll give you my best guess leading into 2023. Otherwise, we will load up Interactive Brokers and take a look at what is going on in the market in general. Zip over here. All right, so looking up here, this little window here, got the blue arrow today. Let's change that back to orange. I think that's a little bit better. So we've got this section up here. We're looking at the NASDAQ trading at 263, down $2.57 or 0.57%. Oh, sorry, I misread that. Almost a percent, trading down 0.97%. SPY trading at 379, down $2.83, 0.75%. IWM down $1.56, 1.9. You know, I always quote these at the beginning of every stream. This is kind of what I'm looking at. These indexes are pretty highly correlated. You know, the SPY and the NASDAQ historically have about a 91% correlation, so they move in tandem most of the time. But there is some differences. Obviously, there's not a lot of oil exposure. I don't think there's any oil exposure in the NASDAQ, whereas the SPY has quite a bit of oil exposure. And oil is definitely one of those sectors that we should be considering for long positions, because they're generally considered value plays. And I believe that there's not a lot of market managers out there looking at growth stocks at the current situation, or in the current situation, which is a high cost to borrow money. And you know, those value stocks should be relatively good plays for 2023. So it's something to consider as we adjust our portfolio. The VIX, as I said at the beginning of this, is up a little bit today, up 7%, marking right now at 23.2. What this means is that 1 year from now, the expectation is that the market in general, when I say the market, S&P 500 or SPY or SPX, however you want to look at it, SPX is the full number, $3,809, should be plus or minus 23% from this current valuation of 38.10. So we can kind of give an estimate over the course of the next year as to what this might look like and where that price point might be. If we click on that symbol on SPX, we can actually look at the chart. Let's just go up here to 1 day. Let's look at the daily candles, and we can see this projected cone that IBKR puts out for us. That if you have that turned on, you can see the standard deviation move. It's interesting, you know. You can see that if we just scroll this over, this is where the expected move is based on historical and the current IV environment. The historical moves where this stock could go. Now, it doesn't mean it's going to, it just means that there's a 68% chance that it's going to stay in that range. So it's something to take into consideration when we're looking at the market, that the markets don't always go up and they don't always go down. Now, obviously in 2022, the SPY ended up down 19% over the course of the year. If we look back at, say, weekly candles, it's a little bit easier to see that downturn that we had. So this is going back to 2020. We can see this drawdown that we had over COVID, and then we had a massive rally. The stock market just continued to rally up above highs. So this was a much needed pullback. if we look back at this 200-day moving average, you see how close we've come to this. And you know, there's a lot of technical traders out there that are looking for this level and looking for bounces off this level. We've already seen it occur once. So could we see a retreat back down to this, 3,700, and then will that cause the market to start to go higher? Oh, who knows, really? It's hard to say what exactly is going to drive the market forward. Ron says everything is good. Thank you very much, Ron. Appreciate that. And Terry's watching from Claire's home, Alberta. Appreciate you guys joining me today. What stocks are you guys looking at today? Is there anything on your radar that is of particular interest, or are you just kind of sitting back and seeing what's happening? David's watching from Jacksonville, Florida. Rich, good morning, Rich. Anything on Starbucks? Closing in on a recent high. Yeah, Starbucks it's over $100 today. And I still have a slightly bearish position on. So my assumption is that the stock is going to trade somewhere around this moving average. I think in these types of cycles, I don't expect massive breakouts from these companies stock wise. So there's enough downward pressure in the market that I'm trying to target these averages. So when I look at, especially when you look at it on a weekly chart, it's pretty easy to see where my assumption lies. And I've done tons of videos on this before about how these trades function, or how these moving averages kind of function, and how oftentimes we see like a large up move and then a reversion. Now it's not guaranteed for sure. I mean, these are valuations of companies. It's just that there's a lot of people out there that do technical analysis, and because of that, they end up trading when stocks run up a little bit. So when we see a stock where it is now, let's just go down to the dailies and take a look at this recent move. My expectation is that it's going to pull back into this 95, 92 range. And I'm targeting that pretty specifically. Now, it doesn't mean that I'm not going to make money if the stock continues to go up. My range is actually quite wide. I believe my profitable range on it is somewhere right around 95 to about 110. So all that it means is that my max target range is a little bit lower. So I make the most money if the stock drifts down into here, but I still make money if the stock goes up or down some. And that's kind of how I treat my positions in general. So typically when I'm looking at a stock or a new entry, I'm aiming wide, and then I'm tightening down to kind of chase the stock price, so to speak. And with the VIX today at 23, I mean, this is a prime time to be opening new positions. So if we look at Starbucks, let's just look at something like an iron condor, because that seems like an appropriate type of trade for the new year. So iron condors, let's go out to February. Rate at 45 days is the monthly expiration. It's pretty nice. Now, with iron condor setups, we could do a $5 wide or a $2.50 wide. Let's see what the $2.50 wide sets up as. So I look mainly at the delta. Everybody always asks me, well, where am I looking? Well, I'm looking at the delta. We can also see on IBKR this kind of darker blue range, this one standard deviation move, and in the center of the strikes. So this section shows me which strike selection without looking at that number, but it's specifically the delta value that I'm looking at when I'm setting up a trade. So on the 110, there's an 18 delta. For selling the 110 call. And you can see on this top side, there's only $5 wide strikes, which means that I can't set up a proper iron condor. This would be a broken wing if we look at it, because it's going to have $250 of spread width on one side and $5 spread width on the other. And this ends up being quite margin intensive for a trade like this, because IBKR requires a different margin for both sides. I have to put up $250 and then 500. And it's showing here that 750 US is showing at 1,025 Canadian, because I'm a Canadian and I have my account set in Canadian dollars. But I can reduce that margin by actually adding a little bit more risk to the downside. So now when I have $500 on risk on both sides, this is an iron condor, and you can see this margin impact now is only $500 US or $683 Canadian. This, when we set up iron condors, we're looking for the probability of profit, 67%. That is perfect. That's right in the range where we would expect. And then it shows the break evens 88 and 111.38. So let's go back to the chart and take a look at that. So 88.62 and 111.38. So looking at Starbucks, and if I was just to draw some lines on here, I can go up, I can add a horizontal line at 111.68. And you'll see that this also corresponds with that standard deviation move. And so there we go. That's the 67% window. So if I was looking for for a new setup in Starbucks, $5 wide, it collects a little bit less credit than I might like. It's collecting $140 approximately to open this trade. So I would go here, I click 142, then I would go submit. And what we're doing when we're setting up an iron condor like this is we are buying our protection right off the top. So there's the only defense for trades like this is to tighten the trade into either a fly, we can tighten it right down. And we never go inverted on limited loss trades like this because there's no advantage to that. We end up in a permanently losing trade. It's better to just close them early if they do get tested. What we're doing is we're looking at these dotted lines. We can see if it does move dramatically prior to expiration, we haven't had max loss immediately. There's a curve to it. So if the stock moved down closer to $75, I wouldn't necessarily be taking max loss in this trade if I closed it early. So typically on a setup like this, I'm putting them on around 45 days when the VIX is at this level, when the VIX is around the 23 mark, and then I'm taking off the trades around 21 days to expiration. So that means I would be taking this off later in the month before the 1st of February. And if I wanted to do this, let's just fill this. Let's see what goes on here. So we're buying the Starbucks February 17th, 85 put. That's the protective. All that money is going to be hopefully thrown away and we're not going to have to use it. What we want is the stock to stay between $90 and 110. So we're selling the Starbucks February 17th 90 put, which is currently out of the money and will lose its value over time, which means that this $142 credit that I'm collecting today will become less and less every day that I hold it. That's called theta decay. And we can look at the value of the theta decay. So this short put is losing value at approximately $3.80 a day. And the long put that I'm purchasing is losing value at $2.80 per day. So I'm making about $1 per day on this trade. Same on the top side. So we've got a $3.90 positive theta, and we have a negative theta of 0.24, which is $2.40 because there's 100 shares. So the total trade is making around $2.50 per day in theta decay. When we're this far out in time at 45 days, this is a pretty accurate number. So we can expect if the stock didn't move and the IV didn't change, that this trade would just decay in value about $2.50. And in about a month's time, it would be worth about $60 less. So the hope would be that we would be able to close this for around $80 a month from now, and we would have a profit. And it's a fairly healthy profit if you think about what the max risk is. Like the $363 that can make 60 bucks is the expectation. So let me just pull up the calculator here and we'll run that math because I like to do math on this channel. That's kind of the fun part about being an options trader. So say we collect 142 credit today, and if we have to buy it back for $80, then we're going to make a realized profit. If everything went perfectly, we'd make a realized profit of $62. And that would be the hope. And we divide that by the total amount of capital risk, which is $363. And you can see this is a 17% return. So we times that by 100 to get so 17% return in a month. It's an extremely lucrative style of trading. Now, it doesn't mean that we can just go all in and go whole hog on these types of trades because they don't always work out. So I like to kind of spread it around. I'll put on a trade on Starbucks, and then I'll put one on an SPY, and I'll put one on in the Qs. And these are the types of setups that we can use for that. Ron is asking, I just bought a 100, 105, 110 call butterfly on Google, 37 cents. Okay, well, let's take a look at Google. What date, Ron? You'll be able to tell here once we pull it up, but let's do, I'm wondering if you did it in this cycle, I doubt it. And I typed in I always use GOOL. I don't know if it's just because I'm lazy, there's one less character, but I always use the OO and not the OOL. It doesn't really matter which one you go, or which one you do. So let's look, 105, 110, call butterfly. So butterflies are, we're buying a wing, we're selling two wings, or we're selling two strikes in between, and then we're buying another wing, all calls in this case. And selling two of those, so 37 cents. And the idea with that is the max risk is the debit paid today, so 37 cent. And the potential is that it could make money if the stock moved up between 100 and 109.61. That's an extremely wide break even for a $37 trade. Let me just take a look here. We're on Google. So if the stock was going to move up in February, and now butterflies have to be right at expiration. So we would look out here and say, oh, what's February, right? Yeah. February 17th. So that would be this zone right here. If the stock was trading here and in between here and here, that $37 could potentially be worth up to a $500 credit to close, which means that the maximum return on the trade would be around $463. It's super unlikely. I mean, the stock would have to literally pin right here at 105. So the expectation would be, I would hope that, you're making like double or triple your money. At $37, making like 90 bucks would be awesome. Anything better than that is gravy. So pretty interesting trade. I typically don't trade trades like that are open for a debit. I generally, what I do in these types of situations is, what I do is I either sell a broken wing butterfly. And the reason I do this is because then I can open it for a credit. And in this case, I can't, but it would be a much more risk to the upside. But it's something to consider, especially if you're doing multiple contracts. It can keep the initial value a little bit lower to open, and so a little bit less out of pocket, meaning if the stock doesn't move in the direction that we want it to, then there's a little less of a loss. And sometimes what I might do is I might sell one of these, like I'll sell a broken wing butterfly, one of those, and then I might sell a regular butterfly as well, the 1-2-1 setup. And then I know I have some upside risk, and I've got, my $30 bet, but I've got two chances of going up into this massive profit. And if the stock runs down, then I can actually adjust some of these. I can actually take these 110s off and potentially take the risk rate off of this trade completely. So because I'm getting in for such a small amount, if the stock did move down before it moved up, there would be a chance to adjust it into a virtually free butterfly, a little bit cheaper. So it's always trader discretion, these types of trades. But I typically do this setup a little more often than I do a setup where I'm just strictly a debit. But then combining the two is a valid plan as well, especially when it's low risk. Like $37 is a pretty small bet that Google could go back up. Well, I should talk about, I don't know if you guys caught the video, I did do a new spreadsheet. It's actually really cool. This backtesting weekly options. It just shows if you're looking at weekly option trading, it basically allows one of my ETF calculators, one of my backtesting ETF calculators. I combined it with a complex option calculator comparison, and so you can backtest up to 3 different option strategies on a weekly basis. And this is in Canadian dollars. You're seeing this 34 bucks, that's Canadian. So if you check out my website, then this will be a different price depending on which country you're in. That's the short plug for that. Where's my website? There it is, covering my face. Okay, and then Dave says, Apple's at a 52-week low. How would you play this stock? Well, it's funny, Dave. I actually just picked up some Apple shares this morning. I didn't get it the smoking deal that it was this morning, but I got them because I was assigned some short puts that I had in play. I've been and continue to be bullish Apple, and I think they're a very, very strong company, and the chart is reflecting that, there's been a fair bit of selling at this point. And, Apple, like any stock, is trades in some sort of range. So right now, obviously, a very, very low valuation. You can see we've had some down runs before over the last year, and then they resulted in returns back up. These highs are getting lower. So we're seeing this kind of movement. So I don't know if we're going to see higher highs than this. I currently don't have any position in Apple that will make any money over 144. So my expectation personally is that the stock will not be recovering into this zone. I will only be making money if the stock moves up from its current level and up to 144. That is my current assumption on Apple. And it's based a little bit on this chart, but it's mostly on just the environment that we're in right now. I just believe that it's going to be a harder time for stocks to make money. And we could be in a position where we see a little bit longer downturn than we've seen in the past. I don't know if you guys remember, but in 1999, when we saw the dot-com crash, we actually saw 3 years of decline. So we saw 2000, 2001, 2002, were declining years. And this, I think, is a more similar setup than what we saw in 2008, which was an immediate recovery. I don't have a graphic specifically for that, but if you look up historical price moves of the S&P 500 in the last 40 years, typically when we see a down year, we see the following year be a bullish year. I'm not so certain in this case. I mean, we may be flat, we may be slightly bullish, we may be bearish. Do we have a huge amount to go down? I don't really think so, but that's just me, I probably would have said the same thing in 2000, that we had such a massive drop that I wouldn't have expected that we would have seen a further drop, but we did for 2 more years. So something to think about with your trading, and how do we make money off of our positions? My focus always is making money on positions moving sideways. That's where my focus is. I'm looking at this price right now of Apple and saying, how can I make money if Apple stays at this level? If it drops, then sometimes I increase my deltas. Like I have today, by buying another 100 shares, I've gone longer Apple. I have put my position in the gear where it's going to make some money if Apple recovers a little bit. That doesn't mean that I'm so optimistic that it's going to go back up to 180. It just means that I'm a little bit longer than I was before. So something to consider. You see, there's a bunch of people online, 11 people, which is fantastic. Why don't you guys let me know if there's another stock you want me to look at? Otherwise, I'm going to just look at the list and we'll see if there's anything fun on here. Alcoa. Looking at the 44 mark, I've been playing this kind of in these levels, these mid 40 levels for a while. This this is where, as kind of a range trader, I don't chase these up. On this move, when Alcoa moved up like this, I keep on my monthly trade with the hope that the stock is going to come back in line. And because I trade in that manner, the positions kind of suffer a little bit for a short period of time when the stock pressure comes up like this. But then when it comes back down, I somehow look like a hero because I was just tracking what my expectation was, that it was going to stay somewhere along the moving average, the recent moving average. And we are downtrending here a little bit. So we can look at multiple examples on this, like Etsy. I actually leaned a little bit longer on Etsy than I probably should have, but because it has the potential of really ripping to the upside. But when Etsy hit 130 up in these levels, I actually started to add to my deltas at this point. But you can see my primary position was actually at the 120 strike. That was the hope that the stock would come back down to the 120 level. And it's actually past that today. So we were looking at that on the 30th. It was right exactly where I was hoping. Now it's a little bit lower. But again, this is we're talking about maximum profit there at 120. It still means that I'm profitable. I think my profitable range on Etsy is massive. It's like a 145 to 185, something like that. Like it's a huge range with the most money being made right here at the 120 mark. And then the further it is from that, the less I make, but I'm still making. This is the full range is profitable. And I do this in a very kind of simplistic way. I mean, I trade on stock like this. I have long stock, and then I sell in the money covered calls on it. So I was trading in the money covered calls at the 120, and I was also trading naked calls to give myself a synthetic strangle on those positions. Blackstone, BX, that is a stock that I don't trade. BX, are they doing really well? No, not so. Would have guessed this chart would have been a little bit better. It's interesting. So I'm assuming Blackstone is the finance. Occasionally I come across a ticker I haven't traded before, but I'm assuming it's like Blackstone Inc., right? It's the peers. Well, this is financial, right? And Blackstone, BlackRock. Yeah, financial asset management, Blackstone. Okay. Yeah. I mean, this is what I expected. Market cap, 85 billion, 3,500 employees, quant rating, sector rank, industry rank, 73. I go to Seeking Alpha. I like using Seeking Alpha. They've got a really good algorithm, pretty inexpensive product. If you guys are interested in checking it out, I do have a promo code that they give me because I am an affiliate of them. And it's like the first year is some ridiculous price right now, like $39, and you can sign up for the 2 year for $249, I think, for 2 years. And normally it's $240 a year, so it's a pretty good deal right now. If you're interested in signing up for it, this has been a great addition to my trading recently. I've only been using it about a year, just under a year, and the pro account, and this quant rating right here, it's been so accurate. It's been so crazy. So I can't say enough about it. I've paid for lots of services over the years. The articles are ho-hum sometimes. Like any service, you can have like an author that's super pro a company, and then you can have an author that's completely against a company. But when I'm looking at this kind of stuff, what I'm looking for is number evaluation. So I want to see some sort of algorithm that's been set up to read these financial charts and to read the options and to read the current number of shares being bought and sold and combine all that information and say, well, what is the likelihood? What's the direction? And anybody can write that kind of stuff. It's not like it's the be all end all, but when you have something pre-written for a very inexpensive amount, it can help add to our trading. So what these algorithms do is they're looking at all of these numbers. They compare it to historical valuations of other companies, inclusive of the company itself, and then they give it a rating based on a bunch of factors. So they have like a overall quant rating with the quants. So the rating is just like a quick. It's either a hold, a buy, a strong buy, a sell, or a strong sell. So there's a kind of color coded here. We see dark red, light red, orange, light green, and then green. And then we can quickly at a glance see whether or not the company is profitable, whether or not it has good momentum. We can see that it has terrible momentum right now. The stock has been downtrending, and a lot of this stuff is pretty obvious. I mean, like you can look at this and you can say, well, there's the momentum. I mean, here's the 200-day moving average. It's clearly moving down. Is there opportunity here for this to go up? Well, this is really where combining all of these sectors and saying, well, the growth is a C+. What's happened here? Something is. Oh, sorry. I just highlighted over this. Didn't mean to do that. It's covering up the stuff. The revisions. So and then we can look back in time and we can actually see what the changes were, whether or not it was profitable, and it does it on a day-by-day basis. So it's pretty cool. I mean, and it does it on any stock that we want, most of the American stocks. So at this point in time, it's a hold. Stock has been rated a hold for a long time. You can see it was rated a sell just briefly last year. And then you can see how this algorithm kind of functioned. There was a time where it was buying and the stock was going up, 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 up. And then as soon as it turned to a hold, it was evaluating and saying, well, here it went down a little bit. Same one with this, that told us it was a buy, stock went up, changed to a hold, stock went down. We can see the buy happens in most cases. Here's one that it did not happen. But most of the time when there was a green buy signal, the stock actually went up. And some of them are crazy. Like, I bought a position in Build-A-Bear Workshop, which I never would have traded ever without seeking alpha. They still have a strong buy on it. And when the stock was at $12, where was it here? I think it was in, so down here last September, I put on a bullish trade. I had no idea that the stock was going to double. That was a crazy call. I just never would have expected it. So here, it must not have been $12. It must have been right around 14. I didn't make a huge amount of money on it because I didn't take a trade that was expecting that it was going to go up as much as it did. I have a handful of shares that doubled in price, but for the most part, I made a nice, healthy return on some option trades on this buy rating. But I kind of missed out. Well, and these are things I'm trying not to do in the future. So we can look at like top stocks by quant, and we can kind of look through and say, are there any stocks in here that might pique our interest? And sometimes there's just a bunch of stocks that don't mean anything, but I've never even heard of them. But if you look at like Caterpillar right now, has a strong buy rating on it right now. The valuation is poor. So it's actually showing that we're a little bit high in current price valuation. We've got decent growth, profitability is huge, and the momentum right now is really, really great. So that's kind of one of the things that we can do, just looking at this quant rating to add to our trading. So Blackstone, let's go back to that. So we know that it's a hold rating on Seeking Alpha. So let's see if we can pull up some sort of trade that'll make money if the stock trades in some sort of range. We'll look at this February 17th. So what I'm going to do is do it in a slightly different order this time. We'll look down at the bottom of the cone and we'll say, what if we picked by strike rather than by delta? So let's look at the 62 and then the 88 and see if we can put up a play here. Find the chain. So we're looking at BX and we're going to go out to February 17th. Now it's not quite as nice. We can't do 62. There's not as wide as spreads, but the 65 is paying more than 1% by a long shot. There must be earnings coming up here. Let's go to list view and we'll look for, I don't have earnings turned on in this little demo account because it's a paid, and I'm not sure why the IV isn't showing, but we've got a 47% IV in January and then a 50% IV in February. So I would assume that the earnings is going to be in February, and then I'm assuming that it's going to be up before. So if we're selling strangles, we're selling iron condors, we're looking somewhere in this range of like 16 delta to 30 delta. So when the strikes are this wide, looking at a strangle, we've got this 21 delta, and then on this side, we've got a 24 delta. That's about as low as I would go. Pretty easy to play this on this type of stock as a strangle with unlimited risk to both sides. We've got a little bit better theta decay. This one has a $9.30 theta decay on it, just as the strangle by itself. So we collect $370. There's a 69% probability of profit. And you can see the break evens right here. Marking at 61.38 and 88.62. So that's kind of the range, and that's exactly what we were looking for. When I looked at that chart, we were looking at 61 and then 80, 89 range. So I've deleted those, but that's where they were, was right at the top of this cone. So 89 and then 61. So that's the type of trade that I would set up, because I don't need to have a directional assumption. I don't need to make money if the stock goes up or down or sideways. I just want to make money if it plays somewhere in this range. And as long as there's no earnings, then this would be a trade that would decay over time and lose some of its value. So we get that theta decay of $9 a day. It is using margin. It uses, in this case, just over $2,000 Canadian, or around 1,500 American. And there is risk, but I don't think that the stock is going to go back up to 117 in this market, nor do I think it's going to go to $30. So I would be comfortable trading something like this. Now, defined risk strategies, again, a little bit harder to defend in a strong move, but can be quite lucrative. So this one on that 45-day cycle, 169, that's exactly where we want it to be credit-wise. The only thing about this is the probability of profit is slightly lower than ideal. So this is 61%, and generally 65% is the mark. So when you're trading iron condors, there's a couple things to just kind of remember about timing. 45 days is the kind of generalized optimal time to put on, assuming that we're going to take it off around 21 days. It means the theta decay is very consistent. So this trade would make about $2.30 a day. Remember, again, this is now a very limited trade. This is only a $350 trade. So a $350 trade that's making $2 a day is actually a very good percentage-wise return. The second thing to take into account is probability of profit. We want to have, on condors, we want to have more winners than losers. So some people go really, really wide. I don't love it to do that. I find that when I do take a loss, then I'm like, well, that loss just ate up a bunch of wins, but it can work. Let's just take a look. So the risk is going to be more now, $418 risk to make $82. So, well, $90 is likely what the fill would be. But the risk reward ratio on this setup is not that great. So we have a little bit of reward and a lot of risk in play, higher probability of profit. But when you do take a loss, if you have one loss, then it wipes out how many? It's like a 4-to-1 ratio. There's one losing trade takes out 4 wins, and I would much rather have a trade that takes out 2 wins. So that way, even if I'm only winning 2 out of every 3 trades, I'm still break even. And historically, the rates are much better than that. If you play enough of these types of trades, the win rate should be closer to 80%. So we should be winning about 4 out of 5 trades, which is why I want my wins to be, my ratio to be better than this. Because in this case, if I did win 80% of the time, then one loser took out 4 wins, then I would be at 0 with an 80% win rate, which is why I like to take that little bit higher risk. This is why I don't love a stock like BX, because there's not the strike selection in here. This is where I'd want to micromanage in between, and I don't have the ability to do it. So if I was going to play this because of the wide wings, I would probably forego this, and I would just allocate a larger amount. I would play this as a strangle, with the expectation that if it moved one way or the other, that I would tighten it down. So that's kind of how my assumption on something like this. Andrew's asking NVIDIA earnings. NVIDIA, I sigh, like NVIDIA's hurt me somehow, but it hasn't. I've actually done pretty well with NVIDIA this year. I've been playing this range. It has dropped down a little bit lower as of late, but I currently have my max target range above 160 and below 180. So that's my assumption, is that it's going to move up into this range. I believe we're just slightly below my profitable range right now. We're trading right about where my cost basis is, which is a bit unfortunate. No, if I added up all the premium that I've collected this year, I've done pretty well in NVIDIA overall. So I'm not going to complain about it by any stretch. Just this recent movement has been a little bit more than I would have liked. We saw quite a strong move up, and it was really kind of breaking out here, which is just those kind of moves I don't love as a neutral trader. And then to reverse back down as far as it did, it's just like, it just becomes not very fun trades. And Nvidia has been kind of chopping all over the place. So let's look at TradingView and see what it did on the last earnings. I don't have a TradingView window open. Just let me pull one up here. I like to use TradingViews. I just use the free service on it because it shows the earnings, and so we could look at, well, let's look at BX. Let's go back up for a second and look to see where the BX earnings is. So there's earnings on BX on January 26th. So we knew it was coming up somewhere there. It's both after the January cycle, but before the February cycle. So trading a strangle on that does have some earnings risk, obviously. And looking at what BX has done on the previous earnings doesn't look like there's anything massive. There's a fairly big candle, but nothing is. This is the daily chart that we're looking at. Yeah, a bit of a gap here, but nothing was crazy on BX. I mean, it trades in its range here pretty closely. So let's look at Nvidia. Nvidia, I feel like on earnings has bigger moves. So Nvidia's earnings are coming up on the 22nd of February. So I'm not sure. Am I looking at the wrong stock? Nvidia earning. Andrew's asking about an Nvidia earnings idea, but I don't see any earnings coming up. So that is, I don't know what to say about that. On the last earnings, the move is actually relatively small. Yeah, they're fairly contained. I feel like the earnings are usually bigger than this, but yeah, a little bit of a candle there. But earnings aren't until February, so I'm not quite sure what we're looking at there. David Herman, price way down on the Blackstone. Yeah, I mean, when we talk about financials, if we just look at that industry in general, look at what the assumption is. I mean, we've been in a period of time where the interest rates were extremely low. Then what people were doing is they're taking their money, they take any extra money that they have and they put it into the stock market. It's like that becomes a no-brainer because the money that they have is relatively cheap to borrow. When interest rates go up, people automatically stop doing it. It's like we're in an inflationary period. Gasoline, food, housing costs are all going up and interest rates are rising. So all of these things are compounding together to make it the general expenses on a month-to-month basis more expensive for everyday living. In that time frame, people are going to automatically not buy as many stocks. That is, we traditionally see a softening stock market when interest rates rise like this. It's why like a bond play might be a better play right now, like getting into, sorry, I say bonds, an interest rate play altogether, like playing the fact that the interest is going to continue to rise. So it's hard to say with any of these companies, but like with a company like BlackRock, clearly they are going to do less business. So of course, shareholders are going to kind of step back a little bit. Are they completely selling out? No, they aren't. Not everybody just sells because it's a downtime, just not as many buyers. And I think we see that across the financial sector. It's why I stepped away from the banks altogether. Like I used to hold CM all the time. I cycled in and out of it. If we scrolled back here and looked at what kind of happened, like this was my entry for CM was down here. When the stock started to see some recovery after the 2020 drawdown, then I rode them up and then I got out here. I actually didn't even play, like from a standpoint of, I didn't play any of this move because I was looking at this going, well, they're already overvalued here. So when they were overvalued there, why would I be buying? Look at this moving average. It's trading way above the moving average. It didn't make any sense for me to buy through this range. This sell-off was a total expected thing in my mind. I mean, here's the level. This is, anybody that's been doing this for any length of time knows where it is. We're even lower than that level right now because the interest rates are high. So this can be good and bad for banks. at this level, this is when I would be considering cycling back in. You know, I don't know if we're going to see a dramatic drawdown like we did in 2020, but we definitely, you know, I avoided this whole zone here because it just didn't make sense to me. Unfortunately, I didn't avoid them all like that. You know, you look at a chart like Etsy, and I mean, I made a video. We made a video just before COVID started talking about Etsy when it's trading at $50. So we were, you know, that was kind of the range that it was trading in when I was at the end of 2019. So I was in Japan here for all of January, February, leading up to COVID. I was actually in Japan when COVID crash happened, and it had been a relatively there was not a lot going on in the market. So luckily this was actually quite a good move here. This tiny little blip that happened, and then this massive run up. I mean, it gave us all opportunity to make some money. But when it all comes down and we get back to reality, you know, when we look at these long-term lines, well, you know, the stock is trading much more in line with where I believe it should be, rather than these valuations up here. And, you know, hopefully people weren't buying at these crazy levels, because there was some like craziness going on up here. You know, that's, it's hard. It's like why Warren Buffett outperformed the market last year, because he wasn't buying into this craziness, and he was playing the longer term outlook. So, and CM, okay, so Terry's asking, is there any way to research which companies have the highest amount of option volume? I'm sure that you could do screeners on that. I don't really use screeners. Terry, like there's lots of people out there that do. There's tons of people. I'm just not one of them. There's tons of people that are like, what's the flavor of the day? I want to try to jump on and play whatever stock it is that's going up, down, sideways. I've never made money that way. It's been too difficult for me. So I play off a list, and what I do is I look for IVR. So in the case of building out a list, I mean, this isn't my complete list, but I have about 200 stocks that I track. And what I'm looking for is I'm looking for extreme moves. Like, you know, looking at BBBY today, seeing this 9% move down, this could be a flag for me to consider getting into a position. And I'm not just jumping on whatever it is that is the flavor of the week, because I have no back history. I don't have any of that kind of internalized knowledge about how the stock has moved in the past, and how what the pricing action has been. And a lot of these companies, because I've been doing this so long, you kind of see them over time. Like Dropbox, I mean, I keep going back to Dropbox. It's up 1.79% today, but I mean, it just basically trades flat. It's like the most boring little trade, and there's tons of value in here. And it's a sideways moving stock. Like it has for the past year, since where was it? January of last year, January 1st, January 3rd of last year, it was trading at $24. Like, how's that for a move? I mean, that's about as flat as it gets from a cyclical stock standpoint. And when you look at this trade, I mean, I have just a continuous trade on Dropbox, and because I'm aware of the pricing action. But there's lots of premium in these, and I don't have to go chasing something. I just know that I'm going to play those same things over and over again, and just play them on the month. So right now I'm right at the 20-day. If we're looking at a short put, it's got 33 cents. I mean, this is in 17 days, that 22 put is generating 1.5% return. That's an 18% annualized return if you don't compound it, just selling the short put. If you were to sell a strangle, the 22.24, well, now all of a sudden you're making a $55 return on a $2,500 product. Let's do the math on that. Let's see what that works out to. So if you're to hold this to expiration, and I'm not saying that anybody should, but if you did, this trade would make about $55. The biggest risk, I think on Dropbox, is likely to the downside. If the stock went to zero, which I don't think it's going to do, but if it did, I would be on the hook for $2,200. So it's $55. If I made this every 17 days, I'd be able to do that 24 times this year. So this strangle makes $1,320. Divide that by $2,200. It's a 60% annualized return on a stock moving sideways. I mean, these are like, to me, this is like the get rich quick scheme, making 60% annualized return on a trade like this. And it's pretty simple. It's, selling a strangle. And if you're worried about upside, if you're worried about exploding to the upside, well, then just cap it. Just put a jade lizard on, or a lizard in general. Still a 62% probability of profit. Still going to make $50 if it stays between 22, 24. And the worst thing that could happen is you lose $50 if it goes up. Now all your risk is to the downside, which is less risk than most people. This is less risk than just owning the stock. I mean, if I bought 100 shares of stock today, I would have to pay $22.76. So I would have $2,276 in risk. So from a risk perspective, this trade has less risk than owning stock and can make 60% annually if the stock doesn't move. It's a crazy amount of money. So I don't need to chase stocks that I don't know. I can just load up on these. CM pays a 5% dividend, 6%. Yeah, the CM is a pretty good, it's quarterly dividend. The banks in general, Canadian banks pay quite high. You can look at BMO, Bank of Montreal. So again, if we just kind of compress this down a little bit, where is that line long term? Let's just back up. The banks are a bit boring, but the Bank of Montreal is, if you were to draw an average line, let's just draw a nice big arrow as close to this 200-day moving average as we could. I'm trying to aim for just before COVID. So I'm trying to capture where the stock was trading just before COVID, because I think that's the most relevant data before the craziness of the last 2 years. This last 2 years has been insane. We saw a massive move down. We saw a massive move up. Is the stock trading close now to that line? It's trading very, very close. So Bank of Montreal may not yet be there. There may be a little bit more downturn, but I don't see there being a ton of downturn here. We're close to this line. And these are decent dividend payers. So I would expect if I go over to Seeking Alpha and I look at BMO, that is going to have a hold rating on it. This is just from looking at the chart, looking at what the expectation is, knowing what the volume is, what the dividend is going to be. The dividend valuations are not that great anymore. I don't know how long you guys have been doing this, but I remember when we were getting 13% annually on a dividend yield. So now I look at a 4% and it's getting lower and lower and lower. It's hard to stomach this. 39% payout ratio. Companies are still paying out the dividends, the dividend isn't as high. I would assume that it means they're not making as much money without reading the numbers. But the momentum is poor here. Valuation is actually pretty good relative, but the growth is poor. The outlook at this point in time is pretty low. Jawbridge Finance, overall, did you fare in 2022? In my risky plays, I certainly took a bunch of risky plays that, they try to make a ton of money. And those ones fared very poorly. I think on if you took all of my risky plays together, they lost half the money that I put into it. It was 50% drawdown. But when you look at my overall positions, I did just barely slightly better than the S&P 500. I was actually planning on doing a little video on that, showing the chart of what my account did relative to the S&P 500. And honestly, it's a little bit sad. I hate being in a year like this where I just personally leaned a little too bullish the whole year. I had the ability to kind of reduce my deltas the whole time, and I continued to hold long deltas while we were grinding down. And so although my account doesn't move as dramatically as the S&P 500 does, because I'm using options and I'm kind of tempering the movement a little bit, the continuous grind down that we saw, I didn't stay delta neutral. I stayed delta long. And when you stay delta long in that situation, you will lose money. You'll lose less, hopefully. So I actually didn't look. I was actually out of town with some friends for the last couple of days for New Year's. So it's been a bit of a whirlwind. So I didn't look at my actual closing day summary, but just on the 30th, I was still just slightly above S&P 500. So S&P 500 is down 19%, and I think I was down like 17% in my big portfolio. So that's the unfortunate woes of trading in long stock positions. Now, also, we have to consider that it's difficult to defend some long positions. Long positions are the hardest thing to defend, because if we own stock and we sell covered calls on it, that only gives us a little bit of cost-based reduction. If I had just owned stock, then I probably would have lost equal to the S&P 500 or a little bit more, because I actually tend to be tech heavy. So some of my holdings, I had less oil and gas exposure in 2022 than I would have liked. So I wasn't making any money on those positions because I just didn't have them on. And then my tech stocks obviously lost a little bit more than I wanted, but then I hold some in cash. So it all kind of balances out. The options definitely help temper it. But overall, I wasn't very satisfied with my performance, being down 17% in a year on my big portfolios, which are big enough to sting. That was not a fun place to be. For it says, Happy New Year. Any change in management of the portfolio with the new year? No, so just to give you guys an understanding of like what I have done over the course of my life, I started trading in 1996. So prior to the .com push, I was trading super small. I didn't have any money. So, when you're young and you don't have any money, it's really hard to dedicate any sort of time to it. So you end up taking like riskier plays, and I made some and I lost some, but I think that time was very informative to me, because what really happened was by 2001, when the market had come back down, I was frustrated with my bank returns. That was the biggest thing. And it was kind of what spurred me on to say, I'm taking all of my money away from the banks and I'm going to self-manage forever, because I just didn't trust them. And I think naively, I didn't quite understand. Now that I've done a lot more research, I really don't trust them, because the MER that they charge is ridiculous. And, as a long-term investor, I can just buy SPY or any version of it. SPLG is the one that I'm buying right now, just because it is a lower MER rate, and I can play options on it. And those plays are very, very simple, and they replicate the returns of the S&P 500, and I don't have to think about it. Those are the big positions, the fun stuff that I do on a day-to-day basis that I'm trading. I try to keep pretty small. I allocate only about 250,000 US to option trading for the kind of play money. And so because of that, I let my bigger accounts just kind of grow as they grow. And I'm just constantly putting in, this year hasn't been a huge amount of putting in, because we bought a new house 2 years ago, and I've been, spending money on that kind of stuff. So it's just been a bit of a different time in my life. And when I look back at like how this trading has affected or how it's functioned, it's been quite good. Like the option trading as a delta neutral trader, like once I learned what delta neutral was, when I stopped being worried about losing to the upside, that's when my accounts really started to grow, and they don't make huge returns, I think my biggest year, I only made like 27%, but still, when you compound it over those years, and then when the losses are less over the year, then, because that's really what it's about, is about reducing losses. When we reduce the losses and then we make pretty good gains most years, then over time those just start to build, and they start to compound up, and the curve is kind of wild. Like when I was younger, you're kind of looking at it and going, well, when is this going to happen? And then it just kind of starts to happen. It is, the money starts to make money, and we have to be as smart as we can about it. My biggest thing for this year is really looking at, continuing to not be as optimistic, let's say. I think that last year was a little bit too optimistic. I thought that the market was going to continue to rise, that we were going to find an easy bottom. As the year kind of ground on, I thought, okay, October, that's going to be the month that we're going to find the bottom. And then October came and I was like, nah, it's going to be November and then December. And if I had stayed more delta neutral the whole time, I would have had a down year, but I would have had a better performance overall, just by keeping a delta neutral portfolio. Do I really want to switch? Not really. One of the hardest parts about trading delta neutral is that if we do get in a time where the market comes back and then it pulls down and then it rebounds, if that rebound happens, you end up losing money on the upside as well. And it's an inherent fear. So what we have to do is just kind of keep my deltas in check. I'm just constantly looking at it and saying, well, where is it going? So Al's asking, are there creative ways that you discovered that you can fix option losses, kind of arbitrage? I feel there are some ways, but you can't find them online except of the options repair strategy. Options repair strategy is just doubling down on stocks. It's not really an option repair strategy. You're just doubling down. You look at a company like Upstart. Try options repair on Upstart. You would have been absolutely obliterated this year. $300 stock trading at $12. Is there a way? Is there look at Upstart still, even at this $12.89, still has a strong sell rating. Just everything is an F about this. And I'm still holding a long position somehow. Interesting though, I am almost at break even on this because there's so much valuation in the monthly options. And by playing delta neutral with these and kind of doubling down appropriately, there's enough theta decay in the out of the money options. Let's just look out in February. There's just so much juice in them. It's not even funny. The stock is here's the puts. So if we're looking at a 1250 put, which is at the money, it's paying $200. Well, this is a $1,200 position. So this is, if you agreed to buy for 1250, that you're getting $200. So you're actually agreeing to buy the stock for only $10.40 by selling this put. The 750 put, which is twice as low as, was almost half as much as the current value, pays 35 cents, which is like 5% return. Like, it's a crazy amount of premium in the calls and the puts on both sides. So the 25, February 17th, 25 call pays, is worth 25 cents right now. That's 1%. That you make, is as long as the stock doesn't double in price. It could go back up to those values because it was a $300 stock. So, but I continued to play long deltas in this, but I reduced them down as much as I could. And knowing that there's so much extrinsic value in these trades that it's pretty easy to get your break even down. But you're playing the high risk of a stock moving in either direction. So are there creative ways? I don't know, Al, if you're part of my Patreon, this is part of my live stream, but I play probably the most creative trades that people trade. I mean, I build software specifically like this, backtesting options. I mean, the whole point of this is to be able to compare, 8-legged trades. I mean, this is an 8-legged multi-contract position, and say, okay, well, what if I want to target very, very specific price action on this? So typically when my trades are super complex, the management of them is already built in because I've taken all of the risk off the trade to begin with. So let's take a look at something that I've been working on for a little while. Let's look at SPY. Looking at like a weekly trade, stocks trading at $380. I haven't actually set it up this week on my software, but let's just say we were going to do a little trade expiring 6 days from now, next Monday. So typically we would do this Monday to Monday. This would be the type of trade that you would do. Pretty simple setup. I say that because I trade really complex things. So we're going to do 4 of the 371 calls. I'm going to trade 2 of the at the money calls, the 379. This is going to give us a delta. So we look at the delta. Delta right now is 214. So I know I'm going to move this down a strike. What I want to do is get this delta to 2. So this gives me a 200 long stock position. I've got 4 calls, 2 short calls. So 4 long calls, 2 short calls. My profit profile is going to be extremely bullish. This is a zebra. It's a 0 extrinsic back ratio spread, and there's 2 of them. So it's just like buying 200 shares of stock, but instead of having to put out $76,000 to buy 200 shares of stock, I only have to put out $2,800 to enter this trade. The next step of that is to sell an at the money synthetic short position to reduce the deltas down to 100. So you can do this in 2 ways. You can either sell 1 strike above, or you can just increase the number of contracts on the 379 and buy out a 379 put. So that's kind of the easiest way to do it. So now we've got a 3-legged contract called the ZEBS, 0 extrinsic back ratio spread with a built-in hedge. It's got a 56% probability of profit, which is greater than buying stock. Buying stock right now is a 50% probability of profit. If we look at a move, what's going to happen? If the stock goes up, I make money. If the stock goes down this week, I'd actually lose more money than owning stock, and that's where the risk is. So there's this valley of death that's pretty deep. If the stock really sells off this week, if the SPY really takes a tank, which could, first week of the year, increased volatility today, I could make this theoretically unlimited money down to $0. SPY is not going to go that low. In fact, I don't personally think the SPY is even going to trade down as low as 343. I don't even think it gets down to 350. That's a huge move. That's a 30-point move on a product that moved $2 today. Do I think it could come down to 369? Yes. So this is a pretty typical trade setup, and I don't particularly love this. So what I was playing with was how do I change this? What if I bought 2 short puts in here and then bought another put, giving myself an embedded put ratio spread? So now this is going to look very much like a zebra, and you're going to say, well, why don't you just put on a zebra? Why do this craziness? Well, the thing is about this, if I set the trade up like this, the management is crazy. If the stock runs up, I have call spreads. I have embedded call spreads that I can sell for profit. I can take the profit off, thus reducing the risk. So in the event that at any time this week the market runs up, it doesn't matter which day, it only has to run up. If the market broke 400, this would be a $2,300 trade. The max risk on this trade is $1,700. So I could potentially make $2,500, and you can see the dotted line is right the same as the solid line. So if it moves any day this week, I basically have a 6-day window of looking for a strong up move, and then I close it, take the risk off, and I've taken my profits. I can, if the move happens. If it goes down, worst case scenario, I make $1,700 or lose $1,700 because I would still have 2 long puts in here. These puts would potentially have to be bought out, but this is a ratio which has a low factor of making money. A low break even on a put ratio spread. But this is a ZEBS with a put ratio spread embedded into it. And that put ratio, I'm buying a 350. So if we're doing the math, how much does it cost? So in this case, it would be a $3.52 debit. And then I'm selling 2 puts here to pay for it. So I'm selling 169 and then plus 169. That put ratio, that limited loss is costing me $14. So if I wanted it to cost me nothing, all I'd have to do is move this up 1 strike, and now it would be a net credit. But I look at this and I think, well, since I don't think that the stock is going to trade down at 300 anyways, and I don't need that kind of hedge in my portfolio, I would rather take this trade that has a lower break even. Break even is only $1 lower than the current price, and only 50 cents. Just $1.10 lower. So than the current price. And it depends on fill, of course, too. You know, this is showing quite widespread. So if I was entering this in my brokerage, I would do the calls. I would do a 4 and a 3 calls, and then I would do a 2 and a 2 put. So this would be 2 different transactions. But no margin, just requires cash. If I get an up move at all this week, I get to take my profits, take off the trade, wait till next Monday, do the trade. So when we talk about like repairing, there's lots of versatility in this. I mean, you can roll the calls, the short calls down for credit to reduce the overall risk. You can ratchet the calls up, so you can move the calls up, or you can just take them off, which is the easy thing to do. If the stock goes up, you just take them off and they're done. And still have the long call in play that could potentially make more money if it goes up. Yeah, so that's some ideas. And then Terry's saying, thank you, Levi, 250K play money. Sheesh, I have a way to go. You know, when I say that, I mean, 250,000. So you have to take it into consideration. Like 250,000 is the amount of money that I allocate, because I feel like in a good year, I can make enough money off of that to sustain my account. And I'm not stressing about it. I think that's the biggest thing when I talk to traders that, you know, they have a $50,000 account and they're just like all in options. Like, $50,000. Well, boy, you have a bad year. And when you've allocated that much, and it's like, well, that is where am I going? I'm losing my train of thought here because I'm trying to think about like how to put this in context. It's a relative thing. So if you have a $50,000 account, you know, then playing options with $20,000 is appropriate. And then having the other 30,000 in something that still can utilize options, but just uses a much safer vehicle. So something like S&P 500 ETF, but then selling covered calls against it, or selling, and if it's a registered account, you know, adjust that within the money covered calls if you need to, or short puts, something that gives us a little bit of an advantage, but still allows us some upside potential. I didn't trade a single option until I had that account, that 250,000. And then that was now 9 years ago. And so that amount is enough that I'm like, I can play with it. I feel like I can make some money, and I could allocate more. I could allocate less, but that's the amount that keeps me engaged and doesn't make me go too crazy. So it's different for everybody. People ask me all the time about like, well, how do you trade options on a smaller account? I don't know. I never did it. I only know that the money comes if you're regimented about it, and you are keeping your losses small, and then keeping contributions going in. There's traders in my group that have massive positions on that are way bigger than I would want to trade. Like there was a guy that was in our group that was like trading $4 million worth of Apple. And I'm like, well, that's insane. Like, I don't want to hold $4 million in Apple, you know, especially on a day like today when the stock is going down. So everybody's risk tolerance is different, and it changes over time. So, when you think about the money, I think that it's good to know that you're playing with an amount of money that is okay, that doesn't cause you stress. That's the biggest thing, is like, don't let it cause you stress. And I'm not trying to downplay that 250,000 is small change. 250,000 is just what I feel comfortable with allocating towards options specifically. So Foyed's asking, thank you. Small suggestion. Is it possible to add a date to your recorded stream in YouTube? Last days, I was watching rewatching many of the older streams. Yeah, I guess I should do that. I should do like a little tag at the bottom. You know, all this stuff is, that reminds me, I haven't updated my copyright even. It's like all of that stuff is something that I could do. Yes, I could probably do that. Does it show? When I'm on this screen, you should be able to see it here. Every time I'm here, you can see my Apple screen shows me the date way up here, January 3rd. So anytime I'm on the screen mode, which is typical, I'm in screen mode most of the time. Anytime I'm on IBKR, it looks like you can see that Tuesday, January 3rd with the time. So we can see 12:17 right now, which means there's 43 minutes left in the market. And what is the market doing? Let's see. Has it changed much? Look, it's recovered a bit since we started. Remember, we started the stream an hour ago and it was down. We were down 0.9%. Now we're down 0.44. SPY has recovered a little bit. IWM has recovered, and the VIX has actually come down. It was at 23 and some change. Now it's at 22.79. Still a nice pop in the VIX. If you look at that, today was a nice day. I opened some SPY iron condors because the VIX popped that little bit. It's not as juicy as it was, but relative to last week, I mean, this was to start the new year. This was not bad at all. We were up in this 23. Anytime that the VIX is above 20, that's kind of the magic line. So this is the bad time. When it gets under 20, we have to start changing our strategies. It's harder to get paid. If we go back and look further, let's just take a look. I made a very excited video about the market crashing in March of 2020. More of February, I guess. Here it is, February of 2020. I was out in Tokyo. The VIX had just been terrible. Like I had come off of an absolute abysmal year of putting on trades that just were basically breaking even all the time. And it was because the VIX was so low. So the whole of 2019, 2017 was by far my worst trading year. If you go back from a return standpoint, I wasn't losing money. I just wasn't making any. And it was just very, very difficult to lose money. This move to the upside, I mean, 80 was nothing that I wanted to see. This was crazy. But when we dropped back down into this zone, I was super stoked, and I had no idea that it was going to last as long as it has. We did get down here at the end of 2021, and I was playing a lot with diagonals at this time when we got down here. We have to be creative when this VIX gets low. I don't know where it's gonna play out. I hope that we get a little bit more market action and we get this VIX back up in the 30s. That would be nice. But if we grind down into these lower 20s, or below 20, back to that area where it likes to sit, this 17, 18 level of 14. When was it back here? Look at this 14, low of 1195, a low of 11. There was just no expected volatility. So if we grind back down into these levels, there's going to be some changes in my portfolio for sure. For right now, I'm sticking with limited loss trades like iron condors. That's kind of going to be the bread and butter. And then looking for any sort of pops to the upside. If something happens, especially with the Ukraine, with price of oil moving, interest rate changes, Fed pivot, there's lots of things that could potentially pop this VIX. Then I'm keeping some money aside to be able to put those trades on. For now, I'm just going to play bread and butter, strangles and condors. That'll be the kind of outlook, at least until we get into earnings, which is coming up here in a couple of weeks. So I was confused, not knowing if I'd already watched or not, since they all have the same title. They do all have the same title. They do have, it should say on YouTube what date they were published, though. I can't look at that right now, but it should say on there what day they were published. And sorry, am I making too many? Am I streaming too much? I don't know. Al, I joined late. Not sure if you already discussed your opinion on Tesla. I almost went long Tesla today. What's it trading at? It hit 107. 107.48. I don't usually touch Tesla. And when I do, I play it with limited loss, obviously, because it's such a crazy moving stock. But wow, that's a price. We had this 3-to-1 share split, so it's kind of messes up the historical, where was it, relative to the 300 was the 900 level before, 107 was the 321 level. So if you're thinking back to pre-split prices, that's what we're thinking about looking at. I have no clue what's going on here. I wouldn't be shorting this for sure because it could whip back up. Obviously, they announced today that they're going to have lower lower quarterly expectation. They're battling exactly what we talked about earlier. People just don't want to spend money, and things like cars are expensive, so they're pulling back on what they're actually spending. Yeah, pretty interesting play. If I was going to trade Tesla, I think I would do similarly to what I was looking at earlier, which is I would play it on probably a monthly, and I would do a call zebra. The reason I would do a call zebra is because then I have a built-in loss, and if the market moves around a little bit, I can adjust it. If you add the Zebs in there as well, so this is, first I have to check my delta. Oops. First I check my delta. So what you want to do is replicate stock purchasing. You can do it at whatever delta you want. I mean, if you only want 79 delta, 75 delta, and maybe that's the way to play it. 86 delta. Because you're ultimately, the more you pay, the further in the money you go, the more you pay. This has a negative theta decay of 18 bucks. So you gotta pay $18 to hold it. Let me just go a few more strikes here. Yeah, 90 delta. Yeah, this is a tough one to set up this way. But so that's giving 90 delta. Okay, let's just go right for the gusto. So the problem is I look at this and I start to think, well, it's not going to go to 92. Then it could easily go to 92. But that's just me, the eternal optimist. You know, there's positive market drift in everything. And at some point, there's people like myself that are looking at a 12% move and saying, well, Tesla's at 107. There's got to be a time where you want to go long. So this gives us a 109 delta, the 92. So there we go. There's 100 deltas. So this is the position that would replicate owning stock to the upside with limited loss to the downside. You see this like slope to the downside. It looks like a married put, 52% probability of profit because it's replicating stock. Then we just add the hedge to this. So we would bump the 107 calls to 3, and we would bump ignore that for a second, that craziness. There you go. So, but here, look at how wide that valley of death is. Like, that is crazy. 106.60. So, I don't know. How do you, like, I don't know how to play this. It's craziness. Do you do this double ratio in here, or do a ratio spread in there? And I tend to do this. I like fixate on like a certain strategy over another, because when I feel like they're right, they can work pretty well. Look at this. This has got $2 break even. So you're basically buying stock at 105.62, and then you have limited loss. Maximum you can lose is $3,000. It does cost $4,500 to enter, but you know, Tesla theoretically could go to 50 bucks. You could lose $5,000. And if it goes up from here, this trade makes money and can be closed right away. Is that the smart trade? Probably not. Let's look at a safer trade. Let's look at a $5 wide condor. 21 delta. Look at this craziness. When on a stock like this, you can trade way wider deltas, because the stock moves so much. I mean, it's a $15 move. So it dropped from 122 to 107 today. So there's a $5 wide condor. Risk reward is not great, because again, if you get stopped out on these, 73% probability. I don't like this trade. There's too much risk. You know, I don't like this risk reward ratio. And this is why oftentimes I don't play Tesla, because the moves are too extreme. So you're setting up a trade that you think you have a high probability of profit, and then you look at the chart and you say, well, that didn't stay anywhere close to the range that I thought it was going to. So Tesla at best is a directional play, I think. But I would still play limited loss. What is the price to buy Tesla? Well, that's the question, right? You want, like, what valuation wise, what's the P&E on it? That's the real question. They are making money now, right? So Let's look at Tesla. I'm assuming this is going to be a sell. I'm seeking off up it. Let's see if my guess is right. Let's go to the ratings here. Oh, it's a hold. Surprised. Surprised it's showing a hold. Yeah, it's kind of right middle of the road. So it's very middle. But you see this, the valuation is still high right here. This is likely because the P/E ratio is a little bit off. So forward-looking P/E is 30, and so that means the price is 30 times more than the earnings currently. So some stocks are getting ridiculously low P/Es right now. I'm trying to think of one that has like a ridiculous low. Here's like P/E on Apple right now, $20 or 20. Well, for a tech stock, for a tech growth stock, that is pretty good. Amazon, let's take a look at Amazon's P/E. See 75. So Amazon's still high, still relatively high, and it's what gives these quant ratings lower. If we look at like something like Conoco, their P/E is going to be really low at 8. So the reason that this is low is because they're highly profitable right now. It's why their stock has done so well, because when we look at this profitability, this A plus, they're making a huge amount of money because the price of oil right now is $78 a barrel. And on a company like Conoco, I don't know the specifics of Conoco, but a lot of oil companies can make money if the price of oil is $40 a barrel. So when the price of oil is $78 a barrel, they're making double what they would make if it was at $40 a barrel. So they're highly lucrative companies, and it's why there's been a shift from growth stocks to those value companies. And when you're looking at large market moves and how we would kind of manage our portfolio, my patrons have seen that. I've been adding more oil positions or more exposure to oil because my expectation is that oil stock companies or oil companies like Chevron, Conoco, even XLE are going to continue to be fairly bullish because the price of oil, I don't think, is going to come back down, mostly because of the conflict with Ukraine and just kind of how the world is set up. I don't think we're there yet with the advent of electric vehicles. I certainly don't think that there's any time in the near future that we're going to see electric airplanes flying around, or electric bulldozers, or electric mass transport vehicles, maybe some semis and stuff, but for the most part, fuel consumption is going to be a major part of our life for a long time. So we all wish that we could be in a greener planet, but I think that if we want the world to continue to function the way that we do, and we want to sit here and watch videos and be on computers, we have to be realistic about it. And the realistic portion of me says, there's oil and gas is going to be around for a while. And at those P/E ratios right now, pretty good, because they're making lots of money because the price of oil is pretty high. I believe we're heading to 80. Yeah, good. We go to 80, we could go further down. I mean, it's on like a free fall. It's the month of which year? I went back even my years. I enjoy the quality of the show. Yeah, the month of sorry, I'm not quite following for it, but I really thank you for enjoying the show. I do try to keep it real here, so I appreciate you guys joining me, spending your time with me. If you guys do like the videos, please hit that like button. It does help. It's one of those silly YouTube algorithms. They still want us to push that like button, so that does help me. And then how do you set up the blue half of the circle that you tell the expected move? I've done that quite a few times. Let me see if I can stumble through it. So this little blue circle, this is what we're talking about, the expected move cone. It's in here under settings, and it should be, it's weird. This is I can never find it in here. Chart setting toolbar, chart zone, chart color, charts. It's funny. I seem to get asked in this question repeatedly, and then I look it up, and then I'm like, oh yeah, this is how you do it. I can't remember. It's in this chart setting, but there's a separate window that's a little bit different than this. And of course, as soon as I turn it off, I won't, I'll remember how to do it. But what you're looking for is a standard deviation move, and it is file, chart parameters. This is where it is. It's under chart parameters. So standard deviation, estimated price range. So you just click this on and off. If you apply that right there, it will turn it off. So there's no blue cone. And then click that on 68.2%, and you can change this. You can do 2 standard deviation or 3 standard deviation. 3 standard deviation is like the 99.9 move, but 1 standard deviation is the expectation. It's a 68% chance, and if we click apply, it'll be there. The other thing that people get confused on, they click it on and then it's not there, and it's because this little arrow is not moved over. So that's a little bit of a hidden thing. So once that's on, you then have to drag the arrow over so you can see what the expected move is. And then it should show on any chart here. So there you go, SPY. So there's the blue cone. Okay, fumbled through that fairly well. Okay, pre-split, I had 900 leaps when it was trading at 150 in my freaking TFSA account. I paid 12K each, now 500. There's still lots of time, but I believe this money is gone forever. Yeah, sorry to hear that. Those are the hard things. And especially with leaps right now, like those long calls are costing money because of one of the Greeks called rho, which is why you can see some discrepancy. If you're looking at like a short put and a short, say you're comparing selling a short put and comparing that to buying 100 shares of stock and selling a covered call, the covered call seems to have more value in it. And it does because there's borrowing costs. The short put doesn't have any margin. It's just margin put up. You don't actually have any cash put out. But when you're holding long stock and then you're selling that covered call against it, that 100 shares of stock has money tied up. And that money tied up, when interest rates are higher, you're devaluing that money because it's tied up in a product that is allocated towards something that you can't get out of. So the interest rates are starting to affect our options. This is going to make leaps a lot less lucrative. You know, we've had a very low interest rates for the last 2 years, and there's lots of new traders. And myself, I was taking advantage of them. I played a ton of diagonal trades where I was buying like 90 delta in the money calls, like a poor man's covered call. And then I was buying other upper calls, creating the trade that I like to use called the unicorn. They work pretty well. As the interest rates rise, we're paying more for those. We have more extrinsic value being sucked out of our account on a daily basis because of the interest rate and the capital allocation of actually putting that money aside and saying, I'm going to hold it in a leap. I'm going to hold this for 1.5 years in a product. That there is cost to that because we could use that money somewhere else. So LEAP stands for long-term. It's funny because it doesn't actually stand LEAP. It's like long-term. I don't even know what. I don't even know. That's hilarious. What does it stand for? LEAP is like when you're buying a call. So you, instead of buying stock, you buy a long call that's in the money, and then you sell short duration calls against it. So we have a, or if you want to be long stock, you can just buy that call and allocate some of the money, and you get the potential upside from owning that stock as if you own stock. There we go. I'll just jump in. Long-term equity anticipation securities. There you go. Thank you so much for that. Like looking at it going, I know it's long-term. That's not LE. That's so funny. So basically anything that's over a year. So if you're purchasing some sort of call that could make money, but instead of owning shares, and it's a typical way that people do to get leverage in their account. Is it smart trading? It can be very lucrative if you're directionally correct. If you're buying something and you're doing it with a small amount of money and you're leveraged and the stock goes up, you can make a lot of money. If you're incorrect, then you're losing money, and you're losing money that's leveraged. If the stock doesn't move, they cost money to own. So when I trade leaps, when I'm owning some sort of long call with the anticipation that the stock is going to go up sometime in the future, I am very systematically selling shorter duration, high theta trades against it. So I would sell a short call against it that's like at the money or just barely slightly out of the money to more than offset the cost of holding the leap long term. I have never been one that allocates a portion of my portfolio to long-term anticipation securities. Thank you, Al. And the people that do it in a very, very small way. I know In the Money, I can't remember his name right now. In the Money, he's a YouTuber. He has lots of subscribers. He uses leaps. He's got some good videos on them. But I'm sure that he, from watching enough of his videos, that he is allocating 1 to 2% of his total net worth to leaps, and that's it. And so unfortunately what people often do is they put way more in, and they think it's like a greed factor. They're like, oh, I can put in $1,000 and I can make $20,000. And it's like, if you're right, yes, it's amazing. But in most cases, you end up like dwindling that $1,000. And so there's a bit of a drag in our accounts over time. All right, you guys are great. It's 12:38. I'm going to zip back over to my patrons and see if there's anything exciting happening in the chat room. I will see my patrons on Thursday, obviously. I've got an exciting new video coming out this week with a little interview that I did. So I've never done an interview before, and that was kind of fun. And so first time, it'll be a new format, something new for the new year. And you guys are great. Where's my button? Let's get rich together and have a fantastic 2023. Thanks so much. Appreciate your time. Take care.